Good morning, everyone. Welcome to Coffee and Conversation with Kristen. Hope you're having a great Sunday today. Wanted to touch base with you and kind of do a longer video today as we're kind of weaning out where exactly are the markets? What did happen to Silicon Valley Bank and what does it mean for the mortgage world, right? So I'm guessing, like so many of the clients I've spoken to in the last week or two, since this has really all become, serious news stuff, is answering the question, is housing collapsing? Is the housing market going down? Okay. And I can, again, in some of my past videos, you will see I can understand why people think that this is the same as 2008 and 10. All of a sudden, market's crazy, low interest rates, high interest rate, buying frenzy, you name it, buy. And then all of a sudden, banks collapse, right? Why I want to tell you it's so different than 2008 and 10 in the housing industry is because we are not in a housing collapse. Remember, we are very low inventory with very high amount of buyers, right? We have people that want to get into the market. That's first and foremost is the inventory. Prior to then, it was really inexpensive to build a house. People were building them all the time. It was inexpensive to purchase them. So it was easy, right? It was easy to buy at 100% financing. You didn't have to have any money in the bank. You didn't even have to prove that you had any pay stubs or anything like that. Much different these days. In all of this, and I promise I will tie all the ends together, but I have been working with clients I've been working with clients for 21 years and writing mortgages. With that being said, though, in this last few months, we are probably have tightened our guidelines more so than ever. And I'm saying that just in general with underwriters. Why? Because whenever markets get tight, we are in an inflation situation in the mortgage world. What does that mean? Well, the Federal Reserve has continued to raise rates to tighten, right? To lessen the amount of people buying. So raise rates, Federal Reserve raise rates, underwriters tighten up their guidelines, meaning you have to have more compensating factors. You have to be a little bit cleaner. Yes, we are going to ask you 2-3 times for pay stubs. We're even going to check and verify your income, not once, but twice. A lot of this has been in since the housing crisis of 2008 and 10. However, people still to this day are like, Kristen, why do you need another pay stub? Kristen, I already gave you my bank statement. Really, you need another one? Kristen, why do you need that 2022 W-2? You have my other 2 years. I'm still working. I can't tell you how many times I answer that question, and point blank, the truth of it is that the tighter our guidelines are, the stronger we hold to them, the reason we won't be in a housing crash of 2008 and 10. So while it is annoying to get us another pay stub, or while it is annoying to get us a name of somebody who can verify your employment even the day before closing, is there for a reason. Just last month, I had a gentleman that forgot to tell me that he got a new job, and the day before closing, we end up calling for a verification of employment. He's no longer employed there. That's a real issue for us as far as underwriting is concerned. So these are some of the small increments of reasons why a lender is annoying you, but also protecting the industry from going into a housing crisis. Those guidelines and those tightening up. So while we all sit back, and I've talked to so many real estate agents, clients, you name it, we're like, Kristen, we've never had to do this before for any other bank or lender ever in the history of ever. Okay, let's just say it aside. Those times are done. It's even different now getting approved for a home loan than it was 6 months ago. You guys, whenever the markets are volatile like this, things change. We have to change with them. Most of these things are put into position not to annoy you, but to protect you, to protect the industry. So there's that. 2, with the bank collapsing. Now, the Federal Reserve is in a really interesting position. We will find out later on this week how this is going to happen, because if the banks and the Federal Reserve, bails out the banks, or like lack of a better term, bails them out, right? We are going to see them give the money, which is going to increase inflation. Well, they're already trying to combat inflation by raising rates. So if they raise rates to a point where people can no longer buy and continue to give the banks money, you guys, I don't know what that's going to look like. So my thought process is we have two options, right? They're either going to bail these banks out, higher inflation, then we're going to figure out what we're going to do with interest rates, or we're going to continue to hike interest rates and then inflation on top of printing more money to bail these banks out, and then Lord knows where we're going to be. However, I've always been under the understanding, and I've expressed more than once in the last probably week or two, that real estate is probably the most secure thing you could diversify your portfolio with and stay safe, even if rates are higher. You guys, did we get a little bit of a turn where we thought, yes, in quarter 2, quarter 3 of this year, rates might come down? Yeah, we were hopeful for that. We saw even a little snip of it in January when we saw just inflation go under just slightly and rates got a lot better. Listen, we are not necessarily in the 7s anymore. We are already probably a point lower than our highest peak and then some. So what does that mean? It's still a great time to buy. If the Federal Reserve just leaves rates where they're at right now for a little bit while we figure out what's going on with all these other banks collapsing, we will be able to still purchase homes, still get into mortgages, right? Now, even if you purchased 2005 and 6 when it was high before, if you held on to your property, did it lose value? Technically it did. However, it then stayed, the valuation stayed, and then it increased over the last couple of years. That value isn't going to go down, you guys. As long as rents remain uncontrolled and people can charge you whatever they want or whatever the market is saying that rents can be, it's going to push people into home ownership. Your 30-year fixed is the reason why people stay. Now, if you've watched videos from me, if you've talked to me personally, yes, there is a position for adjustable rate mortgages. I've always thought that. However, that position is not for the majority of people who took them out last year because they saw seashells by the seashore, anybody? They saw a shiny penny with a little bit of a lower interest rate and then just said, well, you know, in a couple of years, I'll just refinance. No one ever thought that the banks collapsing would potentially change that. Or with inflation continuing to rise, would change that. Can you ultimately say right now, if you're sitting in an adjustable rate mortgage, that you are secure in your thought that rates will go down this year and you'll be able to refinance? And if you worked with a lender who confirmed with you, promised you that this would happen and they will get you out of this rate and refinance you at the end of this year, give them a call today and see what they say. You guys, this is why I never guarantee anything with rates when it comes to the crystal ball factor, because there are things underlying that no one knows about, right? The general public isn't for sure. So what I can tell you is this: real estate wins. Almost 9 times out of 10, if you purchase and hold on to it for a longevity, you are going to come out ahead. If rates fall, and you can make sense of refinancing to capture a lower rate, awesome. That's amazing. The bottom line is right now, you should buy if it's affordable to you with the rates right now, where housing sits right now. And if that means getting out of your $2,500 rental property so you can buy a home and get into a home for $2,000, $2,100 a month on a 30-year fix, knowing that that option is there to refinance, but you don't have to, and you don't have to be concerned about rates going up. You guys, that's a huge win. That's a huge win time over and time again. So while I say we don't know what's going to happen, and yes, rates are a little bit higher than we hope they would be right now, you guys, they're actually very stable. And appreciation at 3 to 5% or a little higher a year that's healthy. That's healthy growth. Okay. And we're going to continue to see that. There is only a small portion of recessions where things went down, and that is with the housing crisis of 2008 and 10. Remember, we are not in that housing crisis right now. Banks, yes. Federal Reserve, yes. Economic turmoil, yeah, I'll say it. We don't know where we are. Everything is so volatile that one little flip of a switch could change everything tomorrow. But what we know is people have always purchased homes. They've always sold homes. They've relocated. I hate to say it, but they've divorced and had to change homes. They've passed away and their family have had to change homes, sell their homes, things like that. There will always be a demand and a need for home ownership. Let my team and I help you with that. We will advise you. We will give you the best advice we can with what we're dealing with. But I promise you, real estate wins always. So if you have any questions, you want to know anything more about it, please don't hesitate to reach out. I'm happy to have a conversation with any of you, whether it be a consumer, real estate agent, insurance agent, just somebody who's interested in the housing market. I love to chat about this stuff. This is where the nerdy side of me comes out. And to be honest, I was a little hesitant to do a video with everything going on back and forth last week. However, I do think it's necessary to understand where we're at. This is not a housing crisis. This is not 2008 and 10 with home ownership. And rates are still very good on an average, on historical averages. So let us help you get into home ownership, solidify where your house payment is at, so you don't have to worry about any landlords knocking, moving next year because they want to increase rent to a point where you don't want it to go. And now where do you go? And also stability, building wealth through diversification. You guys, I have had a pleasure speaking with you. And if you want to know the true difference, I suggest, if you have not, take a look at the Big Short movie this weekend. That's why this is not the same as 2008 and 10. Yes, is that a dramatized movie? It is. However, it will give you a entertaining look of exactly what happened. I worked through it. I lived through it. I made it out on the other side, and we will do it again. You guys, thank you so much for always listening. I appreciate it. Cheers to your Sunday. Bye-bye.